The ASX 200 surged 1.85% to 8,534 points. Inflation printed at 3.7%. That is still above the Reserve Bank's 2 to 3% target band. So why did the market treat it like a gift? The day the ASX forgot about war. For weeks, the Iran conflict had been writing the script. The S&P ASX 200 had fallen 8.9% since the war began. The materials index dropped 18.7%. Oil sat above $103 a barrel. The RBA had just delivered its second consecutive rate hike of 2026, pushing the cash rate to 4.10%. Then Wednesday happened. The Australian Bureau of Statistics released February's CPI data at 11:30 a.m. Australian Eastern Daylight Time. Headline inflation: 3.7%, down from prior readings. Underlying inflation, the RBA's preferred trimmed mean, came in at 3.3%. Within minutes, the ASX 200 jumped from a 1.7% gain to over 2%. Gold miners led the charge. Emerald Resources soared 11.4% to $5.25. BHP climbed 2.8%. Rio Tinto added 2.1%, buoyed further by its $2 billion government-backed deal to transition the Boyne aluminium smelter to clean energy. The All Ordinaries hit 8,748, with ASX futures volumes reaching record levels for March. But here is the number everyone seemed to gloss over: 3.7%. Why 3.7% felt like a victory? The RBA's target band is 2 to 3%. At 3.7%, inflation is still 70 basis points above the upper bound. The central bank has been hiking, not cutting. Bank stocks have slumped, as analysts warn that Australia's inflation trajectory could force further tightening. ASX bank shares are under pressure as rising rates threaten to slow lending and squeeze households already stretched by mortgage costs. Yet the market rallied as though rate cuts were around the corner. The logic is relative, not absolute. Markets were pricing in something worse. With oil above $100, a war disrupting global supply chains, and the RBA in tightening mode, a 3.7% print felt like evidence that domestic inflation was not spiraling. The trimmed mean at 3.3% gave bulls a number to cling to. If underlying inflation was decelerating even as energy prices surged, perhaps the worst was already priced in. There is a problem with this reading. The February data captures the economy before the full impact of the Iran conflict fed through to petrol prices, shipping costs, and input costs. The ABS noted that the inflation reading reflected conditions prior to the most acute phase of supply disruption. In other words, the number the market celebrated is already stale. Dividend stocks with 7% plus yields are drawing attention as investors hunt for income in a high-rate environment. But the very yields that look attractive today depend on corporate earnings holding up through what could be another rate hike cycle. The number that decides what comes next. The last time Australia saw a market rally on a still elevated inflation print was mid-2023, when CPI came in below expectations at 5.4%. The ASX jumped, the RBA paused, and within 2 months inflation re-accelerated, forcing another hike. The rally proved premature. Today's setup carries the same risk. If March CPI, which will capture the full war-era fuel spike, prints above 4%, the RBA will have no room to pause. The futures market currently implies one more 25 BP hike by mid-year. A hot March print could make that too. The conditions for this rally to hold: oil must stabilize below $100, the March trimmed mean must stay at or below 3.3%, and the RBA must signal a willingness to pause at the April meeting. Break any one of those, and Wednesday's 2% surge becomes a dead cat bounce in a tightening cycle. 4D Medical's 38% spike on its Mayo Clinic deal, and New Energy Gas's 125% surge before a trading halt, show that pockets of the market are trading on company-specific catalysts, not macro. But the index lives and dies by the inflation trajectory now. The next CPI print drops in late April. If it starts with a 4, Wednesday's celebration will look like the market popped champagne 1 month too early. Does 3.7% mark the peak, or just a pause before the next leg higher?